Hey guys, I'm Duncan Wilson.
And I'm Sasha Syed, and you're listening to the Mortgage Sweet Spot Podcast, proudly presented to you by Mortgage Sweet.
This podcast is your go-to source for expert insights, innovative strategies, and the latest mortgage trends to help you make the most informed decision regarding your mortgage financing. Whether you're a first-time home buyer, a seasoned real estate investor, or maybe somewhere in between, you've come to the right spot.
So sit back, relax, and get ready to discover your mortgage sweet spot.
Okay, guys, welcome back. First, I know I've been away for a little bit here. How was the Lister situation? Was it good? Was he fun?
Yeah, it was really good. It's very informative.
Cool.
So I basically just asked him a lot of questions, and he explained everything in great detail.
That a boy.
Yeah.
He did just become a mortgage broker, so hooray to him.
Yay.
That is awesome.
We announced that as well, too.
And that's what we do here, obviously, on the team. We want you guys to move to becoming mortgage brokers, which is awesome. So basically today, coming back, I was on vacation. I won't get into that because that'll take up all our time. So I'll get into what the topic is today. And right now we're looking at understanding CMHC, or as most people call it, actually nobody calls this, Canadian Mortgage Housing Corporation. And I mean, Sash, what do you know about CMHC? Go.
CMHC, if you buy a house with less than 20% down, you have to pay their fees. And it can vary depending on your down payment, but they are the Canadian insurer, which automatically insures your mortgage if you're less than 20% down. You do get a little bit of a lower rate, which is nice, but that's because it mitigates the risk for the lender, not the borrower. So CMHC, yeah, they're okay, but they have fees that are expensive.
Yeah, Sasha's got his own opinion, and that's on a different episode, and it's 45 minutes long. It's called Opinions on CMHC by Sasha Syed.
Yeah.
And there is also, so we are talking about CMHC, but what we're encompassing now is CMHC, Sagen, formerly known as Genworth, and also Canada Guarantee. Those are the three insurers in our beautiful country called Canada. And those are the guys that look at your deal and manually underwrite your deal that gets provided by the lender. So we would submit documents to the lender. We'll use FirstNat. FirstNat then compiles it, approves it, but then goes to CMHC, Sagen, or Canada Guarantee. And what they look for is a default insurer premium, I guess you could call it. So basically what it does is it's covering the lender from default. And what it does is it allows, like Sasha's saying, for a major discount on the rate. And that's usually the rates that we provide out on our social media.
Yep.
That's the ones we quote most times. And unfortunately, it's the rate that most people can't get.
Yeah.
It sucks. But in today's market, we have a situation where house prices, and Sasha was getting into this, and I mean Maddie back behind the scenes here. She was like, Sasha, stop talking about that. Use the content on the video. But right now, Sasha, give me the, average home price in Windsor is around $550,000. But new builds, let's talk about the new build situation. I know there's big, huge situation right now. Big, huge news, okay?
Yeah.
And whenever CMHC comes out with big, huge news, I'm like, that's not that big. Like, what's going on? So what is the situation with new builds?
All right. So like today's topic is understanding the new 30-year amortization rule. This is a new rule that the finance minister just released out on August 1st. So any first-time home buyer purchasing a new build can purchase that new build with insurance on a 30-year amortization. So what does that mean? Normally, if you have less than 20%, you're automatically on a 25-year amortization. But in order to make home ownership more affordable, and for those of you who are listening, we're air quoting that, they are doing 30-year amortization. So I ran some numbers before we did this. So are you ready for
numbers? We should love them.
First and foremost, show me any new build in Ontario that's less than $800,000. Okay, so we're using $800K for a purchase price. Your minimum down payment is $55,000. So because you have a 4% CMHC premium for this, you're rolling in $29,800 into your mortgage. So you're looking at $170K would be what you need annually income to qualify if it was on 25 years. But so they're stretching this out an extra 5 years to make it more affordable. Your household needs to have $150,000 and no debts in order to be able to qualify.
Well, I want to point that out. It's easy to have $150K if you had your mom, your dad, your aunt, your uncle, and your brother who doesn't own a house yet. You add them all into the application, you got 150 grand right there.
Yeah,
Boom,
right?
done, right?
Yeah, exactly. So, one of the questions on our sheet here is it worth it? And I guess I'm going to jump to it because, what's your opinion in this? Like
You guys
considering
ready?
all this, right?
So my opinion is the 30-year AM. I think what the government tried doing here through CMHC, and remember, CMHC is backed by tax dollars. Sagen's a private insurer, and Canada Guarantee's a private insurer. But CMHC, the biggest one, the most controlling one, I think they wanted to roll it out to see what's going to happen. But to put it under the guise of affordability, I agree with you. It's kind of BS because at the end of the day, why shouldn't an older home? And I mean, if there was discrimination against new and old homes, man, they'd have a case here. If houses could go to court and sue other houses. Yeah. Like, you know what I mean? But honestly, like an older home is going to be, and no joke, if you want my real opinion, what new first-time home buyer, a kid who's 22 years old, and let's say he makes 150 grand a year, wants to go into an $800,000 new build? What he would more likely want is a starter home. $300,000-$400,000 one, but you can't get a 30-year AM on that. And it really makes me question why even come out with it with this one specific. And I could look at the builder associations going to the government. Maybe the builder association said, hey, we got to offload all these houses we're building. We didn't mean to build luxury homes 99% of the time. Yeah. The other thing too is looking at it, you got the interest rate that you get's lower, but the lower interest rate, having it CMHC insured, doesn't really offset the affordability. And what I mean by that is a 30-year AM on $800,000 going from a 25 to a 30 at $800,000, you're looking at maybe a drop in $25, $30 a month in payment. Yeah. So it's kind of mute, and it reminds me of the government CMHC program that came out where they're going to buy into your home. You know what I mean? Like
the Homebuyers incentive. Oh my God. What a disaster.
They should have called it the homebuyer non-incentive. You know what I mean? Like, we never submitted one deal in regards to that, because every time you talk to the borrower, they're like, so the government's going to own a portion of my home? I'm like, yes, they are. Like, man, why would I want to do that? And even that didn't quell the affordability situation. I mean, the only way to get a new build nowadays that's affordable to a borrower is the builder doesn't finish the kitchen, doesn't finish the bathroom, doesn't finish the basement, doesn't finish the roof. And there you go. You got yourself a $500,000 almost new build.
Yeah, right.
So that's the biggest thing. The 30-year AM does apply. Honestly, we talked about this as insured deals, but it applies to non-insured, okay? Which means you're putting down 20%. And you got to remember, in the last, I've been broken for a while. We always knew that lenders packaged their portfolio mortgages behind the scenes. But let me just explain this. In 2016, we're going to go back a little bit here. 2016, CMHC came out, and what was happening is they have a $600 billion insurance bill. Okay, it's a bill. It's done through the legal courts. And what they do is they associate the $600 billion. They were running out of insurance money. So what CMHC, instead of just jacking up this bill and changing it all, what they did was they started saying, okay, we got to get rid of products. And the first one to go was refinancing. Okay, I was in a beautiful time where we used to refi clients to 90% and go get CMHC insurance.
Really?
Yeah, 90% refis. I was never around for the 95% refis. I don't think that ever existed, but used to get refi. Now, when they stopped insuring it, refinances went to a higher rate. And then what happened was lenders got creative, though, and they started saying, you know what? We need to actually be competitive in the market. So there's this insured rate that you can get, which is insurance premium that the borrower pays. And then there's an uninsured, which gives you a higher rate, usually 20, 30 beeps higher on the mortgage rate. And what I mean by beeps is you're getting 4.79 on a 5-year fixed insured. You can get 5.04 on an uninsured. Then right between that, there's this thing called insurable. And this word has just come out in the last 2 years. I'll be honest, I was confused about it at first because they kept talking about it. But insurable means that you fit the CMHC program, meaning you fit the income is proper, the ratios are in line. And I'm going to go through that. We already did a video on ratios, which is 39-44, but everything fits. What the lender does behind the scenes is they package all your mortgage portfolio. So they package your mortgage application with other applications, and they bulk insure this application. They send it up to the actual insurer. That's where you get maybe a small premium. So 4.79 insured, insurable 4.94, uninsured 5.04. So you see these three separate rates coming out in the market nowadays. And as a broker, I mean, it's like a video game to us. We're trying to figure out what level you get to, and can we get to that next one? Can we add someone? You know what I mean? It's like, what game are we playing today? Like, so that is the three types, but this 30-year AM is still available on the 20% down on non-insured mortgage. And Maddie's just holding up a sign. We got 10 minutes left. Okay, so implications. We talked about the implications of the first-time home buyers. Sasha went through it. It doesn't really help a 30-year AM.
Yeah, it doesn't make sense.
Yeah, it only helps. It helps on the two files last year where I was like, dang it, this is a new build. I wish we had a 30-year AM option for you, sir.
Yeah.
Out of the 1,000 clients I met, there was probably 2 conversations where I was like, man, why don't they allow a 30-year AM? Oh, God, dang it. So that declined 2 clients, and those 2 clients, give me a shout back. Come on back in. We can try and figure out your new build situation. Impact on the housing and market economy. So I would say genuinely, it doesn't really impact. It's not a big enough impact for affordability in our market. There's lots of clients that go and try and find an $800,000 new build, but then come back and say, you know what? I've talked to my realtor, and I really appreciate realtors that do this, saying, hey, that's a lot of money to buy as a new first-time home buyer. So what they do is they go back to buying maybe a $500,000 resell, which is good. My personal opinion is, and I just noticed I talked the whole damn time. Sorry, Sash.
That's
Jeez.
okay.
I think what we're going to...
You haven't been here for a while.
Yeah, it's true. I'm getting it all out now. I think what should happen is they should bring the 30-year AM back. Hey, CMHC, you bring the 30-year AM back out and stop discriminating against resales. Okay,
Yeah,
that's what I want. I want the 30-year AM. I want the 35-year AM option. And I want the 40-year option, okay? We might as well go for more, and then they come back and give us less.
Yep.
But if you can make it, I don't understand how how the government's the one who can tell you, no, we don't offer that. It doesn't really impact, I don't think, the market at all. If you can offer some client a 30 to 35. In the States right now, you can get a fixed 30-year AM mortgage with a 30-year term. And I think it's 6.5%. Who doesn't want that?
Yeah.
Who wouldn't want that option? I think that's a great option. So at the end of the day, I think the government's just coming up with quick things to make everybody go, "Ooh, this is great." It's great for us because it brings in a lot of questions from borrowers who are like, "Hey, can I get a 30-year AM?" But all it does is end up us saying, "No, you can't.
Yeah.
No, you can't. No, you can't. No, you can't." So that's my opinion.
Yeah.
I'm sorry to take up all the time on that.
That's okay. I just want to make a couple of points.
Get her done.
So for the insurable, like one point I think to emphasize is that in this case, the lender pays the premium. It's a very small premium because you have 20% or more, but the lender does cover that.
It's usually 1%.
Yeah, right. So yeah. I've been trying to educate my borrowers about that more. So you eliminate 5 extra years of unnecessary interest and stretching it out to 30 years, and you get the lower rate. So I think I'd have to look at the numbers, but generally that lower rate would kind of balance out that extra 5 years for the monthly payment, right? You know what I mean? So you save 5 years in interest, and you don't have to pay the premium. The other thing too about this new program that's out, the one thing I read was that it's an incentive for construction, for new builds. So I did see the report that came out this week that our construction is actually down, like the permits.
Yeah,
so they're not on target to hit what they're expecting. So I think this is more on first and foremost, I think it's just for headlines, but second, it's also an incentive for builders. So if you can actually afford to buy a new build as a first-time home buyer, it's an incentive for builders to build more.
I guess if I was a builder, I would have read that headline saying, I'm going to build more homes this year because there's a 30-year AM available. Come on, really?
Yeah.
I guess it is true. It does bury down to the fact is that I think it does offload their books. It gets the mortgages approved, but again, wages have to come up with it, guys. So to recap, Sasha, give us a recap on all of it.
Yeah. So this new program that came out is for first-time home buyers purchasing new builds only. I don't really think it's worth it. I think it's just a headline for the Liberals. You need to have quite a bit of income to be able to qualify versus what new builds are selling for today. So I don't think it's a great incentive. I think there's more that they can do. They just, I don't know, maybe their hands are tied. But overall, it's not really a great product. In my own personal opinion, it might be good for others, but like demographic or geographically where we're at, I don't think it's the greatest, Maybe something like Toronto or something, it would work better, but for here it's all wartime houses and stuff, and
correct.
And the new builds going up are $1 million, so who can afford that?
I'm honest. I have nothing else to add. That was a great recap. I hope you guys stay tuned for the next episode.
Yep. And welcome back, Duncan.
Oh, thank you. Thank you, guys. Nice to see you all out there. Okay,
right.
that's
a
it.
wrap.
Ladies and gentlemen borrowers, thanks for tuning in to the Mortgage Sweet Spot. If you have any suggestions for upcoming episodes or questions for our hosts, me and Sasha, throw them in the comments below.
And if you enjoyed the podcast, please subscribe to our channel on your preferred platform. We're available on Spotify, Apple Podcasts, or you can check us out on YouTube. Once again, thank you for tuning in, and we'll see you on the next one.